We got 10 minutes left, a little less than it, almost 8 now. Nathan Peterson joins us, Director of Derivatives Analysis at Schwab Center for Financial Research. Fun day for derivatives, Nate. VIX down, then up. Right now, pushing 25 and above again into the close, and it doesn't look like it's anything particularly strong here set up for us.
No, it doesn't. I always keep my eye, and with the VIX, the one good thing I could say is that as the S&P is making a new low during this most recent pullback, we'll just say a new 1-month low, is that we're not seeing the VIX kind of creep up to a new high. It pulled back from that 30 level. Maybe that's a little bit encouraging. The other thing that I was looking at today is just that 10% correction line in the sand, so to speak, on the S&P 500. It's at 55.29, and about an hour ago, we saw this rally attempt, this intraday rally attempt that just rolled over again. And, right now we're below that 55.29, and you don't want to really be closing at the lows of the day. And the reason I bring up that, why is it important from a trading perspective, at least, to have something like a line in the sand, is that will at least provide some kind of support or confidence for some dip buyers to come in, if even only for a 2 to 3% counter trend trade. But when you're closing at the lows like this and you continue to roll over, even with the RSIs below 30, it's 27 on the S&P 500, it's 24 on the Russell 2000. So we're still kind of sniffing this out, and it reflects, of course, we have the government shutdown potential for tomorrow, and we have these tariff headlines that continue to kind of, be the tape bombs that are hitting the market. And so it's difficult to find our footing here if you're bullish, and you just got to, respect the fact that, yes, the technicals are bearish, but even if we are going into a recession at some point, you can still get some of these really strong counter trend on no news kind of just bounces that can occur. So we got to be mindful of that. We still appear to be selling off on bad news. I'm kind of waiting to see, okay, when we get a new tariff headline, let's see when the market ignores it and actually moves higher. Those are some of the indications that we may be near a near-term bottom.
Okay. How many of those are ticking off right now, Nate? How many of those boxes are getting checked?
Well, let's see. Looks like we're not closing above that 10% level there, so that, we're closing near the lows of the day. What does it mean when you're closing near the lows of the day? Well, that just tells you maybe all the selling isn't done. I'd be looking, so how many boxes have we checked? Not many, to answer your question. The RSIs are there, the oversold is there, the 10% correction is there. You could argue that. But it's still not quite to that point where, I want to see some of the reversal patterns on the chart. So something like a hammer or something like a piercing line cloud. So what that means is a hammer means you would gap down, you sell off, but then you come back up and you close near the highs of the day, putting a hammer on the charts. That kind of price action would be constructive. A piercing line is when you gap down and then you close above the 50% point on that previous candle. These are the kind of technical near-term reversal signals that still have not showed up. So we've got some work to do, but it can change really quick. If we do get that the funding gap closed for tomorrow, that could be enough of an excuse to go ahead and see a reversal in stocks. We've also have Nvidia's GTC conference next week. That could be enough just to say go back into tech. And while we're only down 10% on the S&P 500, if you go over to the AI cohort, I mean, you're down 30, 40, 50% in a month on many of those names. So there's been some just massive selling within the AI complex. And then with that tees up to Nvidia, let's see if we can get some bullish price action out of that.
Okay. Nvidia is like our one hope of all of 11 basis points. I mean, we cut to new lows, so it's just, it's bad. And there's no real life, from bulls. There's not a lot of buyers, not a lot of really nibbling at all, just, pretty persistent. Nate, when you're at VIX 25, and the high was just recently 30, and it doesn't look like VIX is going down. I mean, well, what is our range of options here? At what point does the market just say, hey, let's cut to the chase and dump it all?
Yeah, I know. Like we've talked about before, the
It's like
VIX is just
stair-step.
stair-stepping higher, and you don't really want to see that. You would like to see some kind of climactic spike up to 40, 50, like we saw last August. I know your previous guest was mirroring this current environment to that of last August, but this has been more orderly of a just a stair step down in stocks and a stair step higher in the VIX. And so it's reflecting, look, we've got a 1.4% move on the S&P 500. A VIX of 16 is 1%. That gives you a sense of what the market is expecting on a daily change, maybe 1.7-ish up or down over the next 30 days. Basically telling you that there's still a lot of uncertainty out there, and the economic data is going to be, highly sensitive. We have retail sales next week. I think it was nice to see the non-farm payrolls report for February come in, in line with estimates. It was nice to see JOLTS come in above estimates. It was nice to see initial claims. But there's a lot of skepticism that there is going to be some kind of a report that we get that show or confirms that this slowdown is here. We've already seen it show up in terms of the Atlanta Fed. We've seen it, within earnings reports. We heard it from Delta earlier this week. Dollar General heard it from Walmart. We saw it in retail sales last month. So there's evidence that the consumer is slowing here. And the longer this uncertainty persists, the more it kind of ticks up that recessionary potential. Even if it's only from 10 to 12% or 12 to 14, that still makes it difficult for stocks. When you're at a 20 PE and a recession PE, it should be around 15.
Yeah, fair enough. Thanks, Nate. Like that perspective. Appreciate it.
Thank you.
Nathan Peterson, Director of Derivatives Analysis at Schwab Center for Financial Research. And